wanted to take a look at XLF stock, which is the financial sector ETF. This ETF, one of my favorite ETFs, wanted to take a look at it specifically with regard to a Trump administration, how the financial sector would do with a Trump administration, considering some of the outlook we have for Trump's presidency. Unfortunately, however, there are two barriers that are probably going to affect XLF stock itself to start off with. First and foremost, the Federal Reserve, of course, aggressively expanded the money supply with COVID. Now they're doing the opposite and restricting the money supply, dumping their own balance sheet as much as they can, while at the same time they raised interest rates and are now in the process of lowering interest rates. Unfortunately, might have been a little too soon with lowering interest rates. Number one. Number two, they are also not reducing their balance sheet fast enough. Banks themselves are stepping in and lending at a faster pace than the Federal Reserve is reducing its balance sheet. In the meantime, what's happening is we're getting inflationary numbers popping up that are showing that the Federal Reserve might have been a little too aggressive in reducing its interest rates. On Friday, we get non-farm payrolls. Non-farm payrolls, my expectation is it's a robust number showing that this economy is moving forward. Next week, we get inflation numbers with PPI and CPI. Both those numbers I expect are going to be upsetting to the markets. Interest rates on the long end have already started to move higher. Mortgage rates are pushing 7%. The 10 years pushing, I think it's at 4.61 right now. Then we factor in Trump's administration itself. Trump's administration is very inflationary with what he would impose with not only tariffs, but also continued tax cuts. You combine those two items and the economy, the U.S. economy itself, will slow down. Let's jump in. I'll break down XLF stock, taking a look at some of the major players there and how a Trump administration, given the current economic environment, will affect the financial sector, specifically XLF stock. Quite an extensive intro there. Welcome to D.H. Taylor Analysis. Make sure to hit the like and follow down below, and also the link to my Substack newsletter if that's what you're looking for. I break all this information down in written form so you can see these charts a little better. Here we're looking at the top 10 holdings within XLF stock. Now, XLF is an ETF, exchange traded fund. And these holdings, some of them are some of my favorites. J.P. Morgan, MasterCard, love that one, versus more so Visa. Berkshire, of course, great stock, don't own any shares. Breaking down Morgan Stanley, Goldman Sachs, two excellent companies there. Then you get S&P Global. These are some of the holdings here, and you can kind of see some of the ranges there where the index weight is. Berkshire, of course, holding some of the biggest portion there. Geico, that's really kind of their financial, but then Berkshire itself acts as a financial company itself. Okay, so let's break this down. What exactly is happening? Again, and this is sort of the theme going across the board for the entire U.S. economy. If you've been watching any of my content here or reading any of my newsletters, we're not there yet with the Federal Reserve. Year and a half ago, back October 2023, I was sitting down saying, listen, this stock market's just going to keep going. But unfortunately, the economy is too strong. This was October in 2023, I was saying these things. And I said that the economy will continue to move forward, the stock market's going to continue to move upward, but that I figured October, November, December of 2024, we would start to see a sell-off because the Federal Reserve would act too fast, and they would have to raise interest rates. Federal Reserve didn't raise interest rates. The stock market didn't sell off at that point, but we may be at that point where a lot of the pundits that I've been seeing on the television shows and some of the analysis, if the Fed has to pivot, and in the next, say, 10 days, we're going to find out real fast if the Federal Reserve does have to pivot and how that would affect XLF stock. The financial sector itself, if interest rates start to move lower and lower, they're going to have a lot more capability of lending out because money's inexpensive. But as it turns out, right now, money's inexpensive relative to today. And that's a problem. That's inflationary. Businesses are borrowing at a very fast clip. And I do have the chart, the rate of growth of the money supply and bank deposits. At the same time, I have the rate of growth of the Federal Reserve reducing its balance sheet. When you factor all these things together, you realize one key element, that people are borrowing money today at a very fast pace because they believe the money today is cheaper than it will be tomorrow. That's a huge problem. This will significantly affect the financial sector. XLF stock. Breaking everything down, here's a look at, I've been trying to kind of start just at the very beginning of 2020 with my charts to kind of give a breakdown as to what's happening with any particular sector. We're looking at the S&P 500, the index itself versus XLF stock, the ETF, financial sector ETF. Largely speaking, off by about 13%, 14.5% differential from the very end of 19 going into 2020. Mostly a Trump presidency would be very beneficial to the financial sector because there would be less regulation. There's just two major speed bumps. Currently, the inflation and what Trump's presidency would impose inflationary on the economy via tariffs and the tax cuts. Both of those would drastically reduce, not drastically, but would definitely reduce overall aggregate demand. Tariffs are a tax. When you raise taxes, growth slows. The tax cuts themselves wouldn't necessarily propel the economy forward at a rapid pace because we're already using those tax cuts. Regardless, you could see in the very end chart here how there was a pretty good bump in the stock market after November, the election. But since then, we've kind of struggled a little bit. We've been getting information that doesn't sound rosy. Looking at a closer chart, you can see where the Federal Reserve stepped in and said, we're not going to be reducing interest rates too fast. The problem is we have been getting inflationary data points that are showing that inflation is growing modestly instead of reducing down to the 2% target rate. Federal Reserve balance sheet. Three distinct periods here. You can see in 2007 when QE 1, 2, 1 and 2 kicked in. Then in 2012, QE 3 kicked in. Then in 2020, for COVID, QE 4. Federal Reserve did everything they possibly could to goose the economy during these two economic incidents. Growth wasn't enough. They had to go through three QEs to get growth to where it needed to be. Had started to reduce their balance sheet after QE3, then of course COVID hit. Now the Federal Reserve is reducing its balance sheet. They spiked interest rates upward. Now they're reducing interest rates. But unfortunately, the pace at which they're this is the year-over-year growth rate of the Federal Reserve balance sheet. And we are negative. But let's move forward and take a look at commercial bank deposits and how this affects the financial sector, XLF stock. Specifically, banks were a fractional banking reserve system. If you deposit money into the bank will do everything it can to make money off that deposit on a fractional basis. The Federal Reserve, of course, raised interest rates, reduced their balance sheet, which reduced the rate of growth of the M2 money supply, overall money supply. What we're seeing now is the rate of growth of commercial bank deposits and the money supply itself increasing, notwithstanding the balance sheet for the Federal Reserve being reduced. This is the overall M2 money supply. Now we're above 0%. We are growing. The money supply is growing in a positive. It is positive. We're almost at median. The problem is, what I do not see is the money supply growth rate, which you're looking at here, the year-over-year change, hitting the median and just going flatline and saying, perfect, nailed it. How this affects, say, XLF stock, the financial sector, is basically this. It all boils down to when you pump money into the system, it inflates everything. It inflates assets. Look at any of my videos where I'm talking about housing prices, the stock market itself, gold, oil. There is an inflation of prices. Food at the grocery store. We pay a price for that. These prices continue to grow at an increasing rate. The core PCE versus the money supply, you can see a strong correlation as to what's going on here with the rate of growth of the money supply and prices. Federal Reserve has a real problem on its hand right now. We will see on Friday non-farm payrolls. It's going to be a strong number. We will see next week inflationary data. My belief is these two data points, because of what we've been seeing over the past couple of weeks and months with economic data points, both of these, specifically inflationary numbers, are probably going to be slightly elevated to the point where people are going to sit there and say, guess what? Fed might need to pivot. They're certainly not going to reduce rates at the same pace. But here's the thing, the Federal Reserve may not even need to do that. All they would need to do is contain the rate of growth of the money supply. One of the key tools they have for that is raising interest rates. Another thing they could do is reduce their own balance sheet at a really rapid pace to sort of flatline money growth. If they did that consistently over a solid year, the economy itself would probably grow more gradually versus this sharp spike that we're probably going to see. But then it goes back to, and this affects, of course, the financial sector, XLF stock, and every other sector. The two things that Trump is going to impose upon the economy. First, the tax cuts. This is inflationary. It's highly inflationary. The reason being is simply this. The Federal Reserve was consuming a tremendous amount of debt via brand new blank checks that they were writing. They're reducing that balance sheet right now. Who takes up their spot? Some other entity which would have invested in something else would have to forego that investment in favor of the U.S. Treasury debt. And I think I saw the long end sitting about 4.9, the 30-year. I know the 10 is sitting at around 4.62, 4.61, somewhere in that range. So if the Federal Reserve no longer steps in and consumes that debt, the Treasury has to find another customer. And in order to do that, they're going to have to entice. That means with all the supply we could potentially getting, interest rates, price goes down, interest rates on an inverse relationship goes back up. Because of that, the long end continues to rise. Then we factor in tariffs. This is economically horrible. Great, awesome. That's what Trump wants to do because he believes America's first and we should just conquer the world, take Canada, Greenland, everything, just say North America is all ours. There may be better ways to do that. Take a look at the Shenzhen zone in Europe. Why can't we have a Shenzhen zone here that extends all the way down to, say, the Panama border with Colombia and say North America is all one free zone? you can come and visit this portion of the North America and work if you want a job, but not become a citizen just like they do in Europe. You can move from France to Germany, be a French citizen, have children in Germany, and not become a German citizen. That's the one thing that we're missing. Then all of a sudden we have a lot of inexpensive labor all the way down, all the way to Colombia. It's an alternative. In the meantime, Trump just wants to take everything. So we're looking at the U.S. 10-year Treasury. What is it, 4.68 this morning? I thought it was 4.61. It had been higher earlier. It had been lower. So we're roughly 4.7. Do I think we'll hit 5 on the 10? It all depends. Probably is my best guess when it comes to looking at the long end of the yield curve. Trump, if he does his tariffs, will crush the economy. Not only would we impose tariffs on Mexico, Canada, China, they will do the same, which would cripple economic growth. When that occurs, the next step is real simple. We see layoffs. We see an economy that moves slower, and we see companies seeing reduced revenue and profits. Stock market sells off. So XLF stock would definitely move lower in that kind of economic environment. At the same time, if we see reduced economic growth, more people becoming unemployed, that's less tax revenue, which is inflationary in the long end. So the Trump tariffs would keep the 10, 20, and 30-year Treasury bonds, notes and bonds. Notes are at 10, bonds are at 20 and 30. It's just a word. Those would continue to be elevated for much longer. Mortgage rates, which are pushing 7% at this point, would clear 7% and just stay up there because they react to what the Treasury yields are printing at any particular time. So there's a lot of risk involved and a lot of downside involved in the broader stock market and, of course, XLF stock, the financial sector ETF. With Trump tariffs and the extension of the tax cuts, there's going to be a bigger and bigger deficit. Because of that, the debt will expand, and you're going to need more and more individuals or institutions stepping in to consume that product versus another product. And in order to do that, you're going to have to entice them with a higher interest rate level. We're sitting at about 1.2, 120% debt to GDP. My bet is Trump easily clears 125, pushes through 130 to 135. He could push this economy from, say, 125 to 150 debt to GDP with what he plans on doing for this country. That would be catastrophic for decades. Given where we are currently with what the Federal Reserve has done and what they need to do to keep this train moving forward, they need to reduce their balance sheet at a much faster pace to counteract what is happening with commercial bank lending. Either that, or they need to pivot and raise interest rates. It's going to be a very rough 2025. Plain and simple. I think we've seen the highs in the stock market. We've definitely not seen the highs in the yield in the bond markets. I know I've seen the comments. A lot of you guys are asking questions about my TLT stock and TMF trades that I've been talking about. I'm trying to limit that video and do more content broadly speaking, looking at the entire economic landscape. I will hit TNT and TMF after inflation data when we have a better idea what we're looking at come next Wednesday. Make sure to hit that like and follow button to find out my content on that. We'll see you in the next video.